Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Helt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is Lane Kawaoka, and he is the author of Wealth Elevator. Welcome, Lane.
Hey, thanks for having me. Aloha, everybody.
Great. So Lane, give us your background.
All right. So I call it the linear path. We're all taught to, or at least I was taught to go to school, study hard. I became an engineer and then start to work for the man as an engineer. And I started to follow that thought that we all invest in a 401k, buy a house to live in. So that's what I did. Excuse me. And I started to I was in my early 20s and I was like, wow, in this house all by myself. I was working on the road in construction, so I was never home.
Right.
So what did I do? This is in 2009. I just started to rent it out. And this is kind of where I got a taste of cash flow and rental real estate. And that was the first rental property. Bought a duplex a couple of years later. This is up in Seattle, Washington. So I was doing, the traditional 20% down payment. And then 2015, I had 11 of these rental properties. And this is all remote with property managers. But that's kind of where I felt that pinch. And that's where I was kind of going from that first floor of the wealth elevator, not a credit investor, kind of guy getting started and, becoming more of an accredited investor and moved on to syndications and private placements from there.
So where have you seen the real estate market go from when you first started out, with your first rental to now?
Yeah, I mean, that first rental property I bought for $350,000 in Seattle, Washington. It rented for about $2,200. So we look at this thing called the rent to value ratio.
Mm-hmm.
So you take the monthly rents divided by the purchase price. You're looking for something about 1% or better. So, in certain markets like Seattle, pretty much all of California, New York, Boston, Miami, all the sexy places live. These are what we call primary markets. The numbers aren't going to work. Not going to work. And that's why I eventually moved from the first few units in Seattle to places like Birmingham, Atlanta, Indianapolis, where I could get properties. I think my first property I bought in Birmingham was 85 grand and I rented for like 950, something like that. So 950 divided by 85 grand is over that 1% threshold. Right. So that was back in 2012, right? Nowadays, I would say that same house, haven't checked lately, but my guess is used to be 85 grand. Now it's maybe worth 140 these days. And the rents are right around maybe 1,000 to 1,200. So it's probably dipped under that 1% rule. So as they say, the best time to buy was yesterday. Yeah. But that's kind of how the real estate market has changed this last decade.
We see a lot of people that live in a house and then they are going to buy a new house, and they're either the value may have gone down of their primary residence that they had, and now they want to turn this into a rental property, and kind of get started there. I know you've talked a lot in your book and stuff about with rentals. Can you talk about some of the common mistakes that people are making when it comes to first getting into real estate?
Yeah. I mean, that situation comes up quite often, right? I mean, essentially, that's where I kind of fell into this accidental landlord mode. I owned the property and lived in it.
Right.
But I would say maybe detach yourself a little bit from, maybe this rental property isn't the best rental property stock, right? I mean, just like myself, I eventually sold that Seattle rental property not so long after that because it just wasn't a good rental property. I mean, sure, it housed people, but it didn't house the right demographic, right? Like, so we kind of we stay away from the high end, the luxury class A properties, and we stay away from the low end, the slumlord type, right? In my opinion, there's a nice little sweet spot in the middle, what we call the B class. So, in places like Texas, these are the things that rent for $900 to $1,200 a month, right? It's kind of that lower middle class workforce housing sector or clientele. A lot of blue collar in there, some white collar mix, just to give people a sense. So, I mean, this is kind of where like we will jump on a free introductory call with people. We just hear people's situations out. I mean, first thing I'd probably like to know is like, where is this property at, right? If it's in a primary market, I already know, right? And then we kind of look at the numbers. What is the property worth today? What are the rents at? Kind of compare it to the rent to value ratios out there. And in most cases, it doesn't make sense to hold the property as rental stock. The reason I say that is because most people listen to this podcast here like to live in relatively nicer properties, right?
Right.
I mean,
right.
go figure, right? And so typically they're a little bit better than a class B asset. So, probably better off just selling the damn thing. And maybe you can go buy 3 or 4 rental properties with that. I mean, that's what I did with my Seattle property. I sold it, did a 1031 exchange, and I think I bought 4 or 5 rental properties elsewhere. Pretty much tripled my cash flow from that point on. So that you got to think, from that perspective. But I get it. As I write in my book, there's a big hurdle people need to get over, and that's not having to touch the property, right? Being right there. And some people they can't get over that. I get it, right? I mean, we are working with professional property managers to do our dirty work for us. So why the hell do you need to be there, is what I say. But then, for people who are less, more accredited investors that are more concerned with legal liability, getting sued, I mean, when you're under $1 million net worth, I'm not a lawyer here, so I'm not giving you legal advice, but you're just not a target to getting sued,
Right.
or you're broke. When you are getting, you've passed that $1 million mark, you are much more of a legal liability. And this is kind of what I discovered in 2015, 16, when I had 11 rental properties. I would interact with other accredited investors. And a lot of these guys are very concerned about getting sued for frivolous lawsuits. After all, we live in America.
Yeah.
And they were trading in their rental properties for placements and syndications and private placements as an LP, limited partner, limited liability. And the fact that they're truly passive, a general partner operates the deal for them, and they are just a passive investor. But the cool thing is they are directly invested with the sponsor. So it cuts out all these middlemen, right? Financial planners, all these broker dealers, essentially guys that just take your returns from a deal.
Can you talk about, because you said that, that your place that you had in Seattle was a bad rental property, and that you mainly look for the Class B. Can you explain, what makes a good rental property versus a bad rental property? And to me, the big thing is always the cash flow.
Right.
Lots of
The
times people don't talk
numbers,
about that.
the numbers at the end of the day. I mean, we'll describe it in 2 categories here. Like you try and look for a property that the location and then the asset, right? So I'll describe both, and both of them are ranked in terms of A, B, and C and D, kind of like grade school. So the asset is based on like the age of the property, essentially. So your new builds, your 2000 to current, less than 20 years old, those are gonna be your A buildings. These are going to be the stuff that you and me want to buy, right? And other people want to live in. So it's just going to throw the economics and pricing wonky. You don't want to compete with them. You don't want to compete with the emotional home buyer. Trust me, guys. Some of us don't even want to compete with our wives when we get into arguments, right? Let's be honest. So we're not going to get into a bidding war with somebody who loves the color of the cabinets.
Right.
The Class B is the grade below that. So I would say 1980s to 2000 build, maybe a little bit older, maybe 1970s sometimes. So as you can see, these are somewhat subjective, right? To me, like this is kind of the nice little sweet spot. Now, when you get into the 1960s and older, this is more what's considered Class C properties. And these are just shit just breaks on these things, right? Like we own large apartments. The chiller just goes up. That's a half mil right there, right? And it's just older, right? I mean, it's just what we do is we buy apartments that are kind of in the B class area, put a little lipstick on a pig,
Right.
cosmetic renovation. So new flooring, new appliances, new paint job, very minimal amount of dollars in here, maybe 4 or 5 grand per unit, if that. But we can bump the rents up 10, 20%, right? That's a great ROI. We've done Class C when we first started, but it also attracts more rougher clientele, right? So that's kind of the make of the assets, right? Next is location. Now, location is, you always want to buy a worse asset in a better location. So a Class C asset in a B location, because you can't do anything about the location, right? It is what it is. It's kind of like quarterbacks in football.
Right.
You can't do anything about their arm strength. That's just how it's going to be, right?
Right.
You can somewhat train accuracy in a way. I don't know. People are like football. I'm kind of missing it a little bit. It's been a while.
Right.
But going back to the neighborhood quality, your A class, it's going to make the rent to value ratios not work for you. And I get it. Every new investor wants to be in the best school districts, super safe. Yeah, so do I. I want to drive a gold-plated car too, right? But it's just not going to work in terms of the numbers. The B class is kind of, it's semi-safe. I would probably have, my daughter probably go around there, hang out there in the daytime, but I don't want her hanging out at nighttime at that location, right? So, I mean, relatively safe here. The Class C, I don't want her in the daytime, certainly not the nighttime either, right? But, that's kind of the spectrum. And then, of course, there's war zone type of areas that you never want to invest in, kind of like Baltimore. Not saying anything there, but like people kind of know what I'm talking about. So like, you buy properties in kind of the C and the B areas, and that's, and you buy assets that are kind of in the B and C class, essentially is kind of the idea. But I think if there's something I can get most new investors, they want to buy the pretty assets in the best areas. No bueno, it's not going to work here.
Tell us about your book.
Yeah, so we work primarily with accredited investors, and there's not too much content written for investors going from the first floor to the second floor of the wealth elevator, as I say. And I'll kind of define the floors a little bit later, but there's a lot of books written for people in the basement. That's, I guess, the floor 0. Susie Orman, Dave Ramsey, a lot of financial blogs out there telling you not to drink your $6 latte. I get the need for that. But what do you do when you have a good paying job, as I did 15 years ago out of college? Has it been 15? Yeah, I graduated in 2007. So at that time, I had a good paying job as an engineer. I had a little bit of student debt, but I was off and rolling, but I wasn't a broke guy. So, but I wasn't an accredited investor yet to get into more exclusive deals at that point, nor did I have the network. I didn't know any accredited investors. My parents weren't accredited investors themselves. I didn't have a rich uncle. But I think at that point, what I did was exactly par for the course. And that's, the wealth journey is essentially this journey going through all these different levels. The first floor is buying little rental properties until you get to accredited investor status. I know a lot of people listening are successful business owners. If you're already making over $250,000 a year, you probably jump right up to the second floor of the wealth elevator. Don't even mess with rental properties. It's just a pain in the butt. I'll tell you what it's like to own 11 rental properties. Sure, you get maybe a few $100s per month of cash flow after all expenses. So 11 rentals will give you maybe $3,000 per month of pure profit. But most of my clients need 10 grand or more. And with 11 rental properties, I maybe had an eviction or two every single year, some kind of big catastrophe that happened every quarter, like a tree falling in the house or a flood out in the basement or something like that. And sure, I have my property managers to do my dirty work for me, but it's semi a lot of work. And if you need to increase that to 30 units to get to $10,000, even close to that, now you're talking about an eviction or two it's every other month.
Right.
I mean, and some big catastrophe happening every week almost. So it's just not scalable. I mean, great way to get started on the first floor of the wealth elevator when you're financially younger. But when you become an accredited investor, net worth million or greater, or make over 250,000 a year, just doesn't make sense. And that's kind of where, you know, what we kind of teach investors and have a community for is how do you find deal flow to get directly connected with the deal sponsors, the general partners that operate these sort of country club deals where a group of 50, 100 investors may come in at $50,000 a piece, or $50,000 to $100,000 a piece, and take down a 100-unit, 300-unit apartment complex that has a value-add business plan where you don't have to manage the contractors, the vendors, the general partner. They get carried interest to manage the deal and maximize the profits in that deal. So I discovered this world maybe around 2016, and I was like, whoa, this is cool stuff.
Right.
And what's cool about those syndicated deals, you get a lot better tax benefits than the 27 long, boring depreciation schedule you do at little single family homes. So it unlocks a lot more tax strategies, more advanced tax strategies, real estate professional status. And then, what I also discovered, these guys did this like infinite banking thing, which we also have a free course on my website for that. But this trifecta strategy is very simple things to implement, but very counterintuitive than what our parents taught us. But, this is, again, why the wealthy get wealthier and the middle class shrinks to the lower middle class, and maybe they'll rent an apartment from us.
Can you go back and define the credit investor again? Because you talked about, you've talked about that quite a bit. And you said what it was, but can you do that again?
Yeah, I mean, I think sometimes the definition changes a little bit. So I would say refer to the SEC website or ask your friendly chat GPT there. But essentially, it's somebody with $1 million net worth or greater. And I do believe for an individual single person, you got to make over $200,000 a year income. So it's either or. If you get one of those, you're good. I think married $250 a year, but there's no test. It's kind of a self-certified thing for the most part. It's kind of like if you're pregnant, you don't need to take a test. There's no certificate. You either are or you aren't. There are some people that can get into deals as if you're under that threshold slightly, but I don't know if I would really recommend that, right? Like we've seen the commercial real estate market drop at least 20% in the last few years. I mean, it's had quite a big correction, probably bigger correction than the 2008 market cycle, specifically in commercial real estate. The reason why residential real estate hasn't seen a correction quite yet, who knows if it will, is because commercial real estate is bought on a lot shorter cycles, right? The loan terms could be under 3 years, certainly under 10. So it is a lot more susceptible to these kind of market corrections, where the 30-year mortgage with the residential side kind of insulates it temporarily. But now's kind of the time to get involved, right? The pricing is off the peaks for sure. But yeah, a credit investor, it's not like a test you need to take. If anything, just get educated. And, I think you got to get around people. And here's the hard part is unless you want to go to some crowdfunding website, which is just a broker dealer pitching other people's deals where they have really no skin in the game and just getting paid to promote a deal, you need to actually get off your butt and interact with people, which is difficult. And as an introvert myself, kind of getting out of my shell originally as an engineer, I mean, it was hard for me. I was doing a podcast since 2016, built a community. So that was kind of helpful for me. But, this is why we kind of create a community for people to get associated with other purely passive accredited investors and then get deal flow that way too.
Now, if somebody were to get involved, with one of these investments that you're talking about, and they're throwing in 50 to 100 grand to get into it, what kind of return on their investment are they typically expecting?
I mean, typically you're getting something a little bit higher. I mean, obviously you would for a little bit of more uncertainty and risk, getting off the beaten path here. Um, I mean, in real estate, it depends on your business plan, right? I mean, if you're in a debt deal, which is very secure, right? You're much more protected. Average returns might be on an annual basis, might be 8 to 12%. If you're doing a value add play, right, renovating units, it's the next notch up, 10 to 15. If you're doing ground up development, you might be 15 to 25%, you know, per year. So it obviously ranges. Every deal is very unique and different. And I think if you're someone who is very, I need to have the cookie cutter target date fund thing, this stuff is not for you, right? That stuff is for the masses, right? But if you're somebody who likes to get involved and understand the deal, and for a lot of us, this is fun, right? Um, but yeah, I would say it falls underneath the category. Like the reason why I like this stuff is because I mean, obviously I had an understanding doing rental properties, right? But the tax benefits is what I like too about this world. But you can find higher returns other places. I mean, I'm sure you could invest in Bitcoin. I think those average returns are in the 20% plus range, maybe even 30% plus range. Who knows? Altcoins much higher, but you can also lose it. So to
You say,
me, there's a concept of risk adjusted returns.
right?
I think, real estate, there's much higher returns out there than real estate deals. And obviously we talked about a spectrum, but I mean, as far as like a backed by a real hard asset that actually produces utility in the world, right? Like this stuff, it caters towards the lower middle class, which I believe is a underserved sector. Throw out all the philanthropy and goodness of the world that we need this more of this type of housing for the majority of America's population. I mean, there's going to be a growing demand for this stuff because the middle class are shrinking down and come into the lower middle class and need value apartments from $900 to $1,400 a month. And you get great lending for this type of stuff in this world. And I think, you invest in things, this is more high level, but to me, you invest in things that are going to be around for 10 years plus. You know, it, I mean, certain things you may want to take a more asymmetric approach to, right? Like I think crypto is going to be good for the next 6 months to 2 years. Great. If that's what you want to do. You got your little portion of your portfolio to do that. But to me, I've always kind of looked at like, what are the big long-term trends that are going to be here? The rich are getting richer, the poor are getting poorer, the lower middle class need apartments to live in. You know, I mean, that we're becoming more and more a nation of renters. And then land, they're not making any more of it,
Yeah.
right? So,
That's for sure.
there's. I also think that people like vanity and they want to look good. So, maybe that's beauty products or, life extension types of things. But, I believe in that. I just don't know how to invest in that, right? But here's something where you may believe in these types of investment philosophies, and it's a very, very common thing that people will invest in. You know, I think what's cool about these larger deals is you're getting away from the retail investor. The retail investor is your mom and pop investor who buys a single family house, anything under $5 million. And so when we try and do these apartments or these more commercial grade investments, we try and rise above that common layer so we get a little bit better pricing
Right.
than that crowded area too.
So tell us more about, you have your book that you have a podcast, that you do, and then you also have your website where you do, there is educational stuff there and you do try to educate people. Can you tell us more, about that? And, we understand your why, from where you started out. But, just tell us, more about those items.
Yeah, I mean, on the website, we have a lot of e-courses. I've got my I think it's like 10 hours of master classes, and we just give it away for free. I think something that's always upset me about, especially about the real estate world, is like there's all these silly gurus out there.
Mhm.
You go to their course and then it's a free day. They have like people in the crowd. They run them to the back of the room to make it look like a fake customer. And then they charge you like 10, 20, 50 grand for some BS coaching package where we just give away that stuff for free. Like, you come to the website, you sign up, give us your email address, you get access to that stuff, guys. Especially like for the non-accredited investors. That was kind of my whole goal for the people in that first floor of the wealth elevator. You know, we have content on how to buy your first rental property remotely, things like that. But you know, I think I try and cater towards people like myself, the first generation multimillionaire. Is kind of the my avatar, I guess my soft spot for us. Like it's the person, you know, making 100 grand a year to a few $100,000 a year at a day job, right? They're never going to transcend past $4 or $5 million by the time they're age 60. It's just not possible if you keep doing it the regular way.
Right.
But as I was lucky enough to find very early on in my 20s, like this alternative investment path of directly investing in rental properties and then apartments. And then now we invest in private equity businesses, right? So that's how we like to interact with business owners, because there's all these good business owners that might need $500,000, few $1 million to go buy out a competitor. And you know, that's what we like. I love the entrepreneurial spirit. You know, I'm an EO, Vistage. I like this energy of business owners getting after it. So a lot of our clients are business owners themselves. But the funny thing about people in general is like you're either a good operator, business owner, or you're a lazy investor. Right? It's very rare that you're both of these
Oh, yeah.
things. But I think it's cool if you know you can get a good business owner and you can get them halfway decent as an investor, right? Like kind of understanding this, and part of it is just education and learning by osmosis with other people around you. Dare I say, lazy passive investors around you. But that's, you know, as you in the wealth, going back to the wealth elevator construct, you know, you get past $4 or $5 million net worth. That's what we call the third floor of the wealth elevator. At that point, that's good for most people. I think, you know, maybe you stop investing in alternative investments and you go to like a T-bill or life insurance portfolio and just make 4 or 5% and you're good, right? Most people will say 20 grand of passive income a month is good. Now, I know if I know my business owners well, I know some of you guys like to drink fancy wine and whiskey. Maybe you've had a few pappies
Right.
in your lifetime. So maybe you might want to double or triple that number. So you're gonna have to get past 8 figures, is the saying. But at this point, you have to think about changing from a business operator to becoming a budding family office, right? What's a family office? Typically, family offices are people that are $100 million or greater. This is kind of what we coined the phrase penthouse level of the wealth elevator. You're in the business of investing your money. It may seem like a really easy job, and it kind of is when you got a lot of money, because you now you can start to hire investment advisors, acquisition people, CPAs, lawyers. But the problem is when you try and go from $10 million to $100 million, you're kind of having to do this with fractional CFOs stuff and doing it yourself and learning it yourself too. So this is kind of where you have to just you have to kind of build this by yourself, but you're changing businesses in a way. There's a group out there, Tiger 21. They I think you to get into that group, you need to have a $20 million of investable assets. So, you know, even if your net worth is 20 million, if it's not investable, you technically don't qualify. I would say for our group, we're kind of that scale below that Tiger 21 level, right? I'm in there really working with people and, you know, trying to get them ready to get them to that level, if that's what they want, right? They may not want to get to that point. Most of my folks are very happy if I can get the $5 million and transform my portfolio to more of a cash flow play. Um, that's good enough for them, right? They don't need to take over the world.
I mean, but that's good that you have, you know, with your book and your program that you have, there are the different levels, and you're really showing people how to be able to get to that next level if that's what they want to do.
Yeah, yeah. I mean, people are probably asking, well, how the hell does this guy make money? Well, I'll tell you what, we meet a lot of cool people along the way and give them free education. A lot of it is just and then they book calls with myself, so I vet every single person that comes to our events. We will throw some events throughout the year in person. They're high quality events, and we charge for that. But then we also do deals too, right? We do investments within our community. So this, the idea is just give away the farm and attract a community, which we've had, create a brand and a culture. I think at least that's kind of what been my vibe. I'm here in Hawaii. We're big on like family and living like a tribe in a way.
Right.
You can't take down a 200-unit apartment complex by yourself, not even with a dozen buddies.
Right.
And you certainly can't get diversification with a handful of apartments, right? You really should be in dozens and dozens and dozens of properties. Again, I'm not a certified financial planner. Apparently, I can't not licensed to give investment advice. But what I would loosely say is you never want to have more than 5% of your net worth into any one asset. And that may include your business too.
So, Lane, what if I not asked you wish I had? I mean, we could go on for hours with this because I find a lot of this, fascinating stuff. And I like that you do a lot of education, you give a lot away, for free. Because yes, it does come back at some point in time. So that part's great. But what if I not asked you wish I had?
Oh, sorry. From whose point of view? I'm not following.
No. Just your point of view. I mean, what question did I not ask you that you wish I had, on this interview?
Oh, okay. Okay. Here's what I would say, guys. Like, first step is you got to figure out what floor of the wealth elevator you are. In my book, we've got like a little pull-out chart for people who are a little bit more visual and see where you are. I don't think you guys are on the basement floor, right? You make over $50,000 a year and you have some net worth. But maybe you're on the first floor. Maybe you have to buy crappy little rental properties, right? Maybe you're already past what I call end game, $4 to $5 million net worth, and you don't even need to go into that much alternative investments and get out of your comfort zone. Maybe it's just a matter of just converting it to cash flow plays. Closed-end funds are another option for that out there, where you may want to use a financial planner for that stuff. But I'd say figure out what your cattle grade is and then tailor your strategy for that. But first thing is self-awareness, where you are at. And then the next thing is, you need the community around you to do that, in addition to the education, of course, too.
Great. So, Lane, if people want to learn more about you, more about your program and your book, where can they find all this? How can they reach out to you?
Yeah, they can go on Amazon, pick it up on pick it up in there. We got the Audible version on there, or the PDF, I think, and then the physical copy. If you guys buy it, send us a receipt. team@thewealthelevator.com. We'll give you the electronic version if you want, and the audio version. And yeah, if people want to learn more, they can go back to thewealthelevator.com/master. There's more of a webinar format of the content there, depending on which way you guys like to consume content. But yeah, thanks for having me, Gary. I think the business owners out there, they're great business owners, and I'm always like, man, if you can get just a little bit on the lazy investor side, man, that can create legacy wealth for sure.
Lane, really appreciate your time today.
Thanks.
Hey, everybody. My guest this week was Lane Kawaoka, and he is the author of The Wealth Elevator, and I'll see you guys next week.